Hello, my name is Jeremy Wyeth. I'm President and CEO of Treasury Metals and really excited to be here to take you through our pre-feasibility study that we completed yesterday.
Jeremy, good to see you. Orin, good to see you too. Guys, okay, we're going to go through this PFS in a second because there's a lot of information there which I think would be quite interesting to look at. But I've got to ask the question, why on earth would you put out an economic study in this environment? In fact, most bankers are advising that companies don't do that. Most companies are shying away from it. Why have you done it?
Matt, good question. And we did have a lot of people that said to us, the markets are not right and you shouldn't do it. But I think I need to remind you again, we're a team of people that have built mines, and we all joined this company to take this project through from a PEA to a PFS through FS into construction. And I think if you're part of a marketing and you're marketing the project, but you're not really looking at going out and building it, then maybe you don't put studies out. But when I look at the numbers, we're actually very proud of those numbers, and they're not insignificant. We're talking 336 million NPV at 1750 gold. A couple of weeks ago, we were at 1950 gold, and that takes us close to $500 million NPV on this. Capital's 335 million, 25% IRR. So I think if you may be marginal and you're not really going to build it, then maybe you do step back from it. But I think the message here is we have a solid project and we want to take it through and build it. And you can only get to that stage by going through all the different stage gates, and putting the PFS out is a very important stage gate. And I think, when we spoke, I think on our first meeting, Matt, we spoke about the PEA, and we said it's grounded. We're going to grow the resource. We're going to grow the economics. And I'm very proud to say the team has done that. We grew the resource from PEA to PFS, and now we've actually met or exceeded a lot of the economics from the PEA in the PFS. So, I think it's this thing of we've been there, we've done it, and we're confident in ourselves to do it again.
Okay. Well, okay, fair point. You're a team of mind builders. I think we've discussed that before. Maybe you've got a slightly different approach. But again, if I look at the market, big disconnect between gold price last year and even the beginning of this year and equities. People aren't kind of rushing back in there. Does that not put some fear in you and perhaps concern about what the future holds?
Yeah, I think any developer, any explorer is going to be concerned about the market. We all are. But at the end of the day, Matt, if you want to take a project through the different hoops, you've got to go through the stages. This is the first engineering study after the PEA. And the next step is the feasibility, where we're preparing it for construction. So if you halfway through that and the market picks up, you've still got quite a time span before you can build this. So our plan is to go through those stage gates and get it ready for building. And if the market's ready for it, it will be built. If the market isn't, we have to, reevaluate it. And Orin has a lot of experience in raising capital, so we will evaluate as we're going through. But to be honest with you, if you look at it now, we're probably 12 to 18 months from raising money. So am I absolutely concerned about the market? Not right now. We've got 18 months and we've seen what can happen in 18 months in a gold market.
Okay, well, that's true. Well, look, why don't we run through some numbers? Because what I'd like to understand at the end of it, because obviously these are, a PEA is a kind of, what we could do. This is what we should do. PFS is kind of what we should do, and the feasibility study is what we will do, right? So the numbers are getting more, there's more certainty around the numbers, right? And given the backdrop of what's going on last year, I think it's good to be able to advance projects for sure. Let's run through this, and you've offered to kind of run through a PowerPoint, which I think would be great. So let's do that. At the end of which, what I want to understand from you is the time frame through to feasibility study, because you've done this. Now you've got to go again, feasibility study. But also be looking at your thoughts around being able to continue to reduce costs, whether it be ASIC or AIC, or quite frankly, the kind of type of cash that you could generate. Those are the sorts of things I'd like to get into, really understand how you, over the period of development, improve things if you can. But maybe let's start with the presentation. I think, Orin, you're going to take us through some of that, are you?
I think, Matt, if we just, where we are on that slide right now, we've been through some of the numbers: 336 million NPV, 25.4% IRR at $1,750 gold, 335 CAPEX, 2.8 year payback. So this is solid when you're looking at financing. Those are all things that help us. 13-year life of mine. We improved from under 100,000 ounces per year to almost 110,000 ounces per year for the first 9 years. 1.2 million ounces recovered, less than $900 per ounce cash cost, and just over 1,000. That's for the first 9 years. And Orin can take us through a slide later where we break it up into segments, and you actually see the strength of this project in the first 5 and the first 9 years. And then the part I love about it, it's a technically simple project, and we have huge upside for exploration. We've still got a large belt that is pretty much underexplored.
Okay, but look, you've been doing the phone calls, making sure people have heard this story over the past couple of days since this has come out. What's the reaction been from the institutional guys? Because you're at that stage where they should be starting to look at you, but what's the feedback?
Matt, over the last 6 months, everyone has been saying, put out your pre-fees and then we want to engage, because people generally have had a really positive outlook on the project. But at a PEA stage, they're saying that's typically promotional. Let's get your stake in the ground, put out a PFS. So we've been engaging now. That went out last night. We've been engaging over the last 12 hours with a lot of people, and they're all starting to set up. We have a lot of meetings set up over the next few days, and there are quite a few conferences coming. So the plan is to get out and get the word out there and get the message out there so that people can understand the value opportunities in this project.
Okay. And I'm just sort of looking at the stock price of you and your peers. The last 2 days have been pretty brutal for a lot of gold companies. Not quite sure why. There's obviously things afoot out there. You guys haven't done too bad. You're holding your own. What's your message kind of to the retail guys now in terms of you versus your peers, given the numbers you're demonstrating here?
I think we look today at the market and we've seen a whole lot of people that have dropped quite a bit today, and we haven't. We've been pretty flat. To me, that's a win in a market where where people are dropping and you stay flat on it. That's a win for us. There's not a lot of projects with these numbers in this jurisdiction with the federal EA in place, right on the Trans-Canada Highway, all those items with a team in place that can build it. So our job now that we have the study out is to actually get out and meet with a lot of the retail people and the institutional people and give them that update that they've been requesting while we were busy with the PFS.
Right. Okay. And one more question on this slide, if you don't mind. I'm probably still with you, Jeremy, which is you talk about a technically simple project, right? And with exploration upside. Given the history, given what you walked into, given people's perception of life before you and your team of builders came along, remind us, what have you done which makes this technically simple? Because that wasn't a perception previously.
Matt, I think the important thing here is I've put together a team of people that have all built before. So this is not a learning curve. We're not getting our school fees out of this. This is going in and building it. And we've actually, in this last phase, we were planning to put the study out towards the end of last year. We found some really good opportunities, but it was opportunities from really detailed reviews, again, from people that have been there and done it. And we decided to delay it by a couple of months to actually get that value into the project, because that's important. In markets that are depressed, you don't want to go out with a study that has huge upside in the next phase because the markets are brutal at the moment and you need to incorporate that value. So we've done that now, and we've gone through from all the different areas. We've got way more experienced mining people, permitting people, processing people, and we still have upside. There's not everything is in this, but again, this is part of the process you follow. We've all done this many times. At each stage, you're unlocking more and more potential. And we said, in our first meeting, we'll grow the resource, we'll grow the economics. We've done that. And there's still more upside. In this resource, we don't have silver. So we have silver at Goliath. We don't have silver at Goldland because we sent 30,000 samples away to be tested, and they weren't ready by the time we drew a line in the sand for this resource. So that'll come in the next phase, and there's just another revenue generating opportunity.
Okay, so put the team together. Been there, done it before, get it. And there's a process which you've started, and okay, PFS is out, great. But the question was specifically around the technically simple statement, because, like I say, previously the company struggled. So why is this now technically simple?
If you're in an environment where there previously weren't technical people running it, it was more run as an exploration marketing approach. The team that's here now have actually built and operated mines. So when it's technically simple, the process itself is a gravity CIL gold plant. There's nothing complicated about that. But it's how do you pull together the logistics, the team, and the technical skills to make this a simple project. It doesn't, it has the logistics on this is one of the easiest I've ever seen. So we need to leverage off that. We're right on Trans-Canada. We've got road, rail, power, and gas to our site. So we need to leverage that. The last one I did was for a 400-kilometer winter road. So these are the things where the logistics is very simple. The process itself is simple. The mining is not complicated. It's a basic, small underground mine and a couple of open pits. So pulling it together with a team that understand it, you can complicate this as much as you want to. But the idea is not to complicate it. The idea is to make it as simple as possible, but at the same time, it needs to be robust and it needs to be profitable.
Right. Okay. Answered. Thank you. Orin, can you just sort of take me through the sensitivity to gold price? Because, with a life of mine EBITDA of, circa 1.3 billion, it's starting to be interesting, but there's probably more to be had, right?
Yeah, and so we're using a 1750 gold price as our base case, but if you use, kind of call it current prices of 1850 or even 1950, which we saw, at the end of January, beginning of February, you're starting to get into, 25, 50% higher NPVs than where we're at. And, at base case, you're generating $1.3 billion of EBITDA and free cash flows of $870 million. So you're paying back all that initial capital in 2.5 or 2.8 years. And also during that time, we're growing the underground mine. So, this is something that's generating more than $100 million of free cash flow per year in those early years of the mine life at 1750. So, every dollar of additional gold price you get, that's additional profit that's going into your genes. So, a 25% IRR at these prices, but 33.5 at 1950 gold. So it really shows that leverage to higher prices with this project.
Okay, so as Jeremy described, as you were describing, there's more to be had, but this is a good solid base from which to build for sure. But obviously this, there's going to be, in terms of the production profile, I don't know who wants to sort of tackle this, but in terms of the production profile, I guess the name of the game would be through exploration to be able to, drive that up, and obviously put more throughput, and therefore say for every dollar that comes in, it kind of looks, the future looks good, right? Do you want to tackle that one, Jeremy? Production profile, is that for you?
Yeah, I'll take you through that, Matt. I mean, if you look at that profile, that's ounces per year. just under 100,000 in the first year, then ramping up to almost 130, then sort of staying around the 120, 110 range. I mean, you're talking here 109,000 ounces per year over the first 9 years. And we'll see in a later slide how it's broken up. But the last few years, we're treating, once we complete the underground and open pit mining, we're treating low and medium grade stockpiles. The process we've been through, and again, this is, I think, from having been there, is that we've done everything we can to pull ounces forward. We need to do that. It helps your economics. So we've gone out of our way to pull the higher grade material forward, leave the lower medium grade material for the end. But if you combine that with the fact that this is 330 square kilometers, or 65 kilometers of strike, that's pretty much underexplored. The process here is to bring more material in all the time so that we are not getting to that low-grade stockpile, which is the end of the life from sort of years 9, 10, so 10 to 13 here. So as we replace with additional above-average grade material, that 109 can increase or can continue for a longer period. So for me, it's big enough to build it as it is, but it has this huge upside that this could be 20, 30 years of mine life. At the same time, it will be the only mill in our area. So there are a lot of other properties around us that are just not, if you take this project 7, 8, 9 years ago, it wasn't big enough to build. They're not big enough to build. So we put a mill up and suddenly you've got toll treatment operations, you've got opportunities, we've got the infrastructure. You don't build these processing facilities for 10 years. These things last a lot longer than that. So our job then is to work with the neighbors and fill it, and we can see this facility generate a lot more cash flow for us.
See, that's getting quite interesting. I know we're just about to talk about free cash flow and cash flow generated on this. And I always ask companies that kind of get into production, well, what do you do with it, right? Because usually it's plow it back in the ground, and you don't necessarily get, for every dollar invested, you don't necessarily get $5 back. It's because they bury it in the ground, they maybe dish out a few dividends here and there, and quite frankly, it's maybe not the most efficient or best use of cash. So I'm going to ask you the same question. With the free cash flow that you got, you've just talked about something which I'd not considered before, is what's going on in the district around you, obviously with the mill and the processing capability, cash-constrained companies, smaller companies. Yes, there's tolling agreements. You've already got enough land package to kind of go after your own stuff. So, what are the opportunities around you that you see, and how could you spend cash flow? I mean, we're a ways away, but let's dream for a second.
Orin, I've got some. I'll put in a few numbers there, then I'll let Orin talk to it as well. But we're in a belt that's produced 60 million ounces of gold. And around us, there's another 40 million ounces in 43-101 resources. So it's a gold belt. This is a serious gold belt. So for us, it's a matter of first look at your own property, because you're going to get the best return on that. But as soon as you're up and running, there are time frames that it takes to bring our resources into reserves and get them into the mine plan. So you start that process. It's way better for us to do that and commit that cost out of free cash flow than to be going out and raising and diluting. So you have this opportunity. And Matt, I've worked on mines where each year we grew the resource by what we depleted. So you just keep going. It's a 10-year life of mine, and it stays a 10-year life of mine forever, and it's done out of cash flow. So we have that opportunity here. But then also, there are already people knocking on the door and saying, well, are you interested? We're doing this, we're doing that, we're close by. You're on the Trans-Canada. You can move stuff here quite easily. So those are the other opportunities for us. But, homegrown for us is the first prize. And then second, we move out and we're starting to look. We've started looking at the neighborhood and what's going on. And, there are other people that are getting to a similar stage as us, but they're not big enough. So now's the opportunity. We need to get into production. We can't do that out of diluting and raising money to do that. We must do that out of free cash flow.
Yeah, you talk in the presentation about the first 6-year profile, the first 9-year profile, and obviously Jeremy's talked about a kind of continuing 10-year profile, ongoing 10-year profile to for the company. How has this been constructed in terms of the ambition, or which may involve some of the things that Jeremy's just talked about, and how what you say to retail in terms of dilutionary events going forward, and what have you tried to sort of structure here?
This chart here shows it breaks it out by segments. The first 5 years. That's really what you finance a mine off of from a lending perspective. They look at what's your cash flow profile for 5 years, and then what is the tail? What's the reserve tail after that? So this is showing $106 million a year of post-tax free cash flow. That includes $30 million a year in sustaining capital. Low $820 cash cost, $1,000 all-in sustaining costs. Those are really good numbers. But then even if you break it out, to 9 years and you're still less than $900 an ounce cash costs, $90 million a year in post-tax free cash flows. So that shows the lending profile to be able to build this project. And then it shows that cash flow profile beyond that to say, okay, what are the opportunities beyond that? First prize is what's on your own property. Can we find ounces on our belt? I think there's lots of opportunity for growth within our own backyard. And then let's look what's on the other side of the fence, and can we use those cash flows for that? And then as we're successful in building this, we then have a team of people that have built a project, and you can take those skills forward and find other projects to build this in, to take it from a single mine operation to a multi-mine operation.
Right. Okay. Given none of us can predict the future, I'm kind of looking at the cash costs or the AISC, wherever you want to go. How people prefer to measure these things, but there's a kind of fluctuation there. Obviously, first 5 years look great because you've got a bit more certainty about this kind of high grading that you're going to do at the beginning. You don't know what's going to come through on the exploration, but there again, it takes a long time for that to kind of come into reserves. So. Why do the costs kind of rise year 6 and 9 and compared to the first 5 years?
I mean, on a cash cost basis, the costs go up because your grade will start to come down. So when you're deeper pits in open pits, so your costs for mining are going to go up. But then you are seeing your all-in sustaining costs is not increasing as much because your capital costs are coming down. You're not spending as much on the underground mine as where you were. And then you look at year 10 to 13, there's very little in terms of sustaining costs. So your cash costs versus your all-in sustaining costs are pretty much the same amount there. So even though it's a low-grade operation, it still does generate free cash flows. We are going to want to find ounces to replace those that are higher grade to keep the production profile at, or would be great if we're producing more ounces in those years, but it still generates profits for the operations and generates NAV for the project.
Right, and in terms of capacity, nameplate capacity, are you able to? How quickly can you fill your own mill? How likely are you to need to toll during any period here?
I don't think there's a need for it in the first 9 years. And then if there's better opportunities in years 10 and beyond, we'll look at that. But I think that, we've got a pretty good head start in terms of exploring on our own property to find those ounces as opposed to having to go somewhere else for them.
And I think Matt, if you look at that, you're looking at a 13-year mine life as we stand. We've still got to do a pre-feas and 2 years to build it. So there's another 3 years. So that's 16 years. So it's not like we suddenly saying we got to rush to get extra resources in. We've got time. It's just for us, it's what is the best thing to do for our shareholders and not to go out and dilute, to grow. It's big enough to build, and let's use that cash flow to grow it as we move along, because any drilling we do now will not actually end up in the feasibility study because it would come in first as inferred, and then we'd need to move it into indicated. So it's a couple of year process to do that. And right now with markets the way they are, let's protect the shareholders and look after the our treasury and make sure we keep it full so that we can do the work we need to do to get it construction or operations ready.
So you did touch upon it earlier, but so what you said, there's some things that didn't quite make it into the PFS. Is there existing work which has happened, which will make it into the feasibility study, whether it be the silver or whether it be additional gold ounces? What could we be looking at?
Orin, do you want to talk to the values on the silver? We can talk to that.
Yeah, I mean, there's silver at Goldland. It wasn't assayed for in the past, but we ran all the pulps and samples over the last year. It didn't make it into the resource that went into the PFS, but will make it into the feasibility study. And if you see a similar, silver to gold ratio that you see at Goliath, you could be looking at, potentially another 1 million ounces of silver, which, is at current prices, you're looking at close to $30 million Canadian for the project. So that's, $15 to $20 million of additional NAV for the project, because the plant is already set up to recover silver at Goliath. And so it's a revenue opportunity for us at really no additional cost.
And then, Matt, there are other areas as well that I spoke to, and these are part of what's shown there as the opportunities. Goldland always harder than Goliath ore. So we want to do some more met test work because it carries a treatment premium it's an extra cost to grind. So we want to make sure that is totally representative. We don't want to be designing and over-designing this mold if we don't need to. So we're going to do that type of work. We're looking at, how we're starting to combine packages so that if we combine civil works and pre-strip, how do we get to better packages where we get better economies of scale? Water is a big concern for us. So we're looking at how do we model the water quality and the water quantity so that we can at least make sure that we have the correct treatment facilities, and we're not designing for something that we're not going to see, but we're also not designing that we under-designed on that. And then both underground and open pit, we still see opportunities, how we can improve on once we get more geotech information, how do we improve on the open pit slopes? In the underground side, we've got a robust mine plan, but I think there are opportunities there, maybe in interlevel spacing, how we can see ways to reduce costs.
Okay. Well, let's get on to what, right, I said at the beginning, it's kind of like you got here, but now you need to go again, right? So the next steps are what? What's the kind of big so what for people from this conversation?
Matt, it's right now we've put the PFS out. We're now in a situation to start what we call value engineering, which is some of these trade-off studies that I actually want the answers for before I start doing too much feasibility study engineering, because you don't want to redo stuff. So you do a bit of value engineering into the feasibility, but at the same time, all the baseline environmental work continues. The provincial permitting process is typically based off your pre-feasibility work. So we now have the designs, the layouts, and we can progress that. All the work we're doing with local communities and Indigenous communities is continuing. There's a lot happening there, and we're going to continue that as getting people on board with us as we move the project forward. And then the exploration. And the exploration we've spoken at length about is, when is the right time? When do you go into that? How do you do that? And the team is busy with that. We typically in the summer have some very good programs where we can get on the ground. And there's certain areas we can only drill in winter. So this is seasonal, and we're planning that as to how we progress it. But it's all stations go. It's, we've now got a really good base again. And what I like about this is the base of a PFS is it has more engineering in it than a PEA. And what's great is you de-risking this project as you move it through the different phases. And for me, we're now at a greater de-risking, but we have the same economics. And the challenge for us now is to take it through the next phase, de-risk it even more, and preserve the value in the project.
Okay, well, guys, look, appreciate you coming on and sharing that with us, because I know you're in the middle of you're doing all of those calls that you have to do when these things come out. So last question is, okay, time frame to feasibility coming out is when?
Typically, a feasibility matter is 9 to 12 months. So if we put a couple of months of value engineering and then into it, I'd be looking at early next year, we would see a feasibility study coming out. Permitting process should probably wrap up Q2, Q3 next year. And financing would be a process we would run once the feasibility study is out. You start the process before that, but once the feasibility numbers are out, so you're looking at Q2, Q3 next year. And if all goes according to plan and the way we would like it, we would be looking at a construction decision towards the end of next year.
Okay, and you're financed through to what phase?
The royalty we did last year will finance us through to probably the end of the feasibility study.